Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. As Washington races to pass a historic financial intervention plan, there's still a good deal of information and conversation swirling on the street, and still more to come, and still more questions than answers. But the one still overriding question that remains, are we going down the right path here? So, to help answer that, we've reconvened our Zacks Financial Caucus so they can give their views, starting with Steve Reitmeister, our editor-at-large at Zacks.com. Caucus member number 2, Charles Rotblatt. He's our senior market analyst. And, of course, the maestro himself, Kevin Matris. So, let's start right from the top with what we know about the news that's come out over the weekend. We're recording this on Monday, the 22nd of September. Who among us, or among you, because I don't really give an opinion here, and that puts me in good shape, believes that the government does need to step in at all with a plan to help right the wrongs on Wall Street?
Well, Steve and I talked about this on Friday, and there's two ways to look at it. A, there's the plan itself, and there's criticisms you can make of the plan. But B, what's the alternative? If we don't do something, how bad does the situation get? And from what I'm able to piece together, I think the Fed looked at AIG, they looked at Lehman, and I think something really spooked them for them to kind of do an about-face. And so the question is, if we don't do something and a credit crunch does get worse, we could be looking at a lot of turmoil in the markets.
But we still need more clarity, Steve.
Yeah, the devil's always in the details. As a free market guy, okay, it's very hard for me to agree that we need to step in and do things. But it is a situation where it probably would be a lot worse if the government didn't try and shore up things, try and calm people's nerves, don't have runs on the banks and things of that nature. And hopefully we have accomplished that. But here again, the devil is in the details. What authority do they have to buy loans? What is the potential for the loss as taxpayers? What will be the shape of the financial markets afterwards? And here again, as a free market guy, that we always are afraid of government intervention as bending supply and demand and getting things out of shape. Right. And so here again, I don't want to see unnecessary regulation in the future construct of what the financial markets look like.
Kevin, you're a technical guy, but as we wait for more clarity, what's going through your mind here with regard to the market?
It's when I first heard about the plan last week, I was immediately angry. I thought that the government was overstepping their bounds, and I was wondering what was going on. But as I started reading more about it, as I started really researching what was happening, it seems as if that this is really the best alternative there is. It's not a bailout for Wall Street. It's not a bailout for the fat cats. It's really a bailout of an integral part of our financial system. And the idea that the credit markets would completely seize up, that would affect people like me and you. You wouldn't be able to get a loan for a car. You can't get a loan for college. You can't, small businesses who are trying to start up, they wouldn't be able to get started up. Right. It would really have ramifications over the entire economy. And it looks as if that the government's plan to be able to buy a lot of this distressed debt and create a market for it, if you will, to hold it and then hopefully sell it to people who are willing to assume this debt and create a price, because a lot of this paper, people don't know how to price it. They're not sure what the risk is of this paper, and if nobody's willing to buy it, how can you possibly value it? And as the value of these things continue to plummet, you've got companies who are holding this paper who see their collateralization fall, which means their willingness and their ability to be able to create loans has completely evaporated.
All right, so what we know so far, as the details are concerned, is the size of the package. $700 billion, which in effect, when it's all said and done, could run into the trillions.
Right.
That's what I'm hearing.
Right, because the $700 billion is $700 billion at any one given time. And so they could buy up $700 billion worth of paper, sell off $300 billion, and then go back out and take that back in again. And so what is the entirety of the loss? Here again, that they put in a cap ceiling on the national debt. For those who don't know, that's like $11 trillion. Okay, that's a lot of money. So the devil's in the details. All the ambiguous language about basically the Treasury can make no-bid packages with other institutions, which, as Dirk Van Dyke kind of pointed out, that's terrific for Goldman Sachs because it will go out to their friends, and it does smack a lot of a package that's being rushed through. And that always scares me. We had another set of packages that were rushed through that got us the Patriot Act, and they got us a lot of other things that we're not quite sure we wanted, back about 5-6 years ago. So,
Charles, does this only involve the buying up of bad mortgages, as far as we know today?
That's the way it's structured, but I actually have the ballot plan in front of us. This is 3 pages, and I think that's what's really important for people to realize. It's 3 pages. Not a lot of specifics, gives the Treasury Department unprecedented powers, and in there it actually says that no one can override, including the courts, basically what the Treasury Department does, and the person appointed to run this. Furthermore, they're required to report during the first 3 months of this creation of this new entity, and after that it's semi-annually. So we're going to basically have 9 months into it before we get our second report. So I think there's a lot of loopholes in here, a lot of margin for error. Mm-hmm. And I know Congress right now, there's some talk about, we're going to tack on some measure to control pay. It's not pay where Congress needs to be worried about our mortgages. They really need to get down into details and think long and hard, how does this work?
Control the pay of who?
Really control the pay of corporate executives of financial companies, just to make that clear. But I think what Congress really needs to do is start taking a look at the nitty-gritty, and they can do this pretty quickly. But the bigger thing is, if this package is going to benefit the shareholders benefit the citizens of the U.S. as some proponents of this proposal say it will, the bigger question is then why aren't we making this a loan to all those financial companies? Why aren't we saying we'll loan you the money to buy back all these assets, and as we sell these assets off, you can pay back the loan with those proceeds, or you owe us the money. That would have a far better impact and a far better benefit to the citizens of the U.S. and all its taxpayers than just giving the money out here with a bunch of loopholes and really putting a political appointee in charge of this who really has no answer to anybody. They can essentially do what they want in terms of trying to figure out how to get rid of these assets and monetize.
I mean, if they regulate my pay anymore, I might as well just phone this guy. Let's talk about the markets, Kevin, because you are the technician in the group here. If this is such a good deal as the street, as the people at the top of the street would want us to believe, the top of the hill, let's say, why did the markets not react favorably at the outset this morning?
Well, I think the big massive rally that we saw last week, I think Dirk wrote an article. He called it the mother of all short covering rallies, and it's true. I was reading another article. They said that people were paying anything just to get out of their short positions, and anything is what they paid. But I think people are probably just sobering up to this idea that, hey, this isn't necessarily some boon for Wall Street. Who knows what will happen down the road? But a lot of stocks rallied up last week that really probably had no business in rallying the way they did. And I think people are pulling back and trying to figure out, okay, what's the real value of these companies? How is this going to be valued in the future? What kind of exposure do all of these other companies have? There's so many things that have to be considered. There still are some good places to invest if you're inclined to do so. I think looking at companies with very strong cash positions is a good place to be. You saw Microsoft buy back $40 billion worth of their stock. I think Nike came out, they're only buying $5 billion, but billion, that's a lot of money. Mm-hmm. You have, I think, Hewlett-Packard, they did the same thing. So looking at companies with very strong cash positions who don't really have to rely on credit to expand their business, looking at consumer staples and utilities, I think these are good places to look at. And even looking at REITs that focus on, let's say, apartment complexes where you're going to be renting instead of buying stuff. You're actually renting to people because it's going to be harder to secure loans to buy houses nowadays.
All right, quickly, I want to get something in from each of these two guys here. Okay. Is it too soon to be able to establish a market trend based on the news? Or at what point does it become reasonable to expect we can see a market trend here?
Yeah. If there is a trend, it certainly is a negative one. If you take a look, you're pulling back, you take a look at the picture, it's definitely been down since about October of last year. Yes, you had a kind of maybe rally off the bottom, but here again, was it just a short covering rally, what have you? The real issue is how steady will the American citizens feel with all this going on, and what will happen at the malls over the next few weeks. What happens this holiday shopping season, and the buying activity and the economic discourse going on in this country, that's really what's going to set the pace for where the market is. So in other words, we've already had like an economic slowdown, hasn't been dubbed a recession. That's a topic for another day. But will this drag us into recession? And if so, the market has to clearly go in one direction.
Right.
And then once the recession is established and you start that slow, you might be coming back out, that's when the market rallies. So is everyone's nerve steadied? I don't think so.
What's interesting is that the real economy has been a bit resilient, but consumer confidence plays a big role in how people go out and spend their money.
Okay, Charles, I'm going to give you the final word on that. Do you agree with them?
Basically, I mean, we're looking at choppy markets, and retailers are scared. I was in a mall yesterday, September 21st, and I saw a big Christmas tree up. Now, we've talked before, there's rules about this, and no Christmas tree should be put up in the middle of September. But it does signal, though, that retailers are concerned, and certainly mall management's concerned about spending. And as I've said before, we're dealing with a really big psychological problem where lenders do not trust borrowers. And until we get that, really lenders willing to lend money and getting consumers to borrow money, spend that money, I think we're going to have a little bit more toughness for the economy, more choppy markets for the stock market. We've been in a pretty big trading range for a few months now. Granted, we fell out of it early last week, but I think we're going to have a hard time making a lot of headway until we start seeing what this final proposal is, until we start seeing the benefits. And I think it's anybody's guess as to what point we actually start seeing an uptrend in the market. Hopefully sooner than later, but I wouldn't want to take a guess on it just yet.
Kevin, you mentioned a couple of stocks by name. Do you own any of those stocks?
I do own Microsoft.
Okay. Well, if we've answered one question here, it is that there is still concern. Concern on the street, both Wall Street and Main Street. And I do need to remind you that the views expressed herein are those of the caucus members, not necessarily those of Zacks Investment Research, its subsidiaries, or affiliates. With the whole crew, I'm Terry Ruffalo.